Welcome to The Explainer. So, have you ever looked at the price of your morning coffee and wondered why it doesn't change every single day? I mean, the economy's always in flux, right? Well, today we're digging into the really fascinating theory that explains exactly that. New Keynesian economics. It all really boils down to this one huge question. Is a recession just a natural, even efficient response to something happening in the economy? Or is it a sign that something's broken, a market failure that maybe, just maybe, we can fix with the right policies? Your answer to this question really shapes your entire view of how the world works. To really get to the bottom of this, we've got to step into the ring with two competing economic heavyweights, and trust me, each one paints a completely different picture of our economy. So on one side, you have what's called real business cycle, or RBC theory. This view imagines the economy as this, perfectly oiled machine. Prices change instantly, everything is efficient, and in this world, a recession is just the machine making a necessary adjustment. But then the new Keynesian view says, whoa, hold on a second. The real world is messy. It's got frictions, market failures, and most importantly, prices that they get stuck. They see recessions not as an efficient outcome, but as a big problem that we can and should try to solve. Okay, so what's the single biggest difference between these two worlds? It all comes down to one simple but incredibly powerful idea. Who has the power to set the price? The RBC world is built on this idea of perfect competition. To make it simple, think of a single farmer selling wheat in a giant market. That farmer can't just decide to charge more for their wheat, right? They have no choice but to accept the going market price. They're a price taker. In this world, competition is so fierce that the price gets driven all the way down to the exact cost of producing one more bushel. There's basically no extra profit to be made. But new Keynesian economists argue that the real world looks a whole lot more like monopolistic competition. Just think about your favorite coffee shop or your brand of smartphone. Because their product is a little bit different, they have some power. They're price setters. They can charge a little bit more than it costs to make that next cup of coffee, and you'll probably still buy it. And this graph here, it shows you exactly why that's a huge deal. See that downward sloping line? That's the secret sauce. It basically means a company can raise its price a bit without losing all of its customers. This gives them market power. It allows them to set a price that's higher than their costs, and that little extra bit is their markup, their profit. That's a world away from our poor wheat farmer who had zero power. All right, now we're getting to the really cool part. Because if businesses can set their own prices, why on earth don't they just change them all the time to make as much money as possible every single hour of every day? The answer to that question is the absolute heart of new Keynesian economics. And the answer is prices are sticky. They're sticky because in the real world, it actually costs time and money to change a price. Economists have a great name for this phenomenon: menu costs. And the classic example is a restaurant. I mean, think about it. If they want to change their prices, they have to literally print all new menus. That's a real cost. And if the extra profit they'd make from the new price is less than the cost of printing all those menus, they'll just stick with the old price. And menu costs go way, way beyond just paper and ink. Think about the time your favorite online store has to spend updating its website. Think about the manager who has to sit down and figure out what the new prices should even be. And maybe the biggest cost of all, the risk of really annoying your loyal customers. All of these things create a really powerful incentive for a business to just leave the price alone. So, what happens when prices are sticky? Well, this graph shows the incredible result. Imagine demand for something suddenly goes through the roof. A company that could change prices for free would just jack up the price. Simple. But our company, with its sticky prices, figures it's just not worth the hassle. So, to meet all this new demand at the old price, what do they have to do? They have to ramp up production. They have to make a lot more stuff. And this is where it all comes together. This stickiness isn't just a tiny detail. No, it has absolutely massive implications for the whole economy. And it suggests a very real, very important role for government policy. So check out this chain reaction. Let's say the government or the central bank does something to boost demand in the economy. Because so many firms have these sticky prices, they don't just immediately raise them. Instead, to meet all that new demand, they hire more people, they fire up the factories, they produce more stuff. And the result is pretty amazing. The policy can create a real boost in jobs and economic growth without causing inflation to immediately skyrocket. This insight is a really big deal in modern economics. It's the foundation of what we call the new Keynesian Phillips curve. It shows us that today's inflation isn't just about today's costs, it's also about what companies think is going to happen in the future. Because prices are sticky, they're forced to think ahead. And this helps economists understand that delicate dance between economic growth and inflation. Okay, so that's the theory. But the real question is, how does this all hold up when we look at the actual real-world economy? Does it really give us a better map? Now look, no theory is perfect, and critics ask some really good questions. But the supporting evidence for this view is pretty darn strong. We see time and time again that government policies do have a significant real impact on jobs and output in the short run, way more than that super efficient RBC theory would ever predict. And, it's empirically true. We can all see that firms just don't all change their prices at the same time. So this leaves us with the big takeaway. The economy isn't some perfect frictionless machine. It's got bumps and grooves like sticky prices that can make recessions much deeper and more painful than they need to be. But the good news here is that understanding this opens the door for smarter policies that can help smooth out those bumps. Which leaves us with the trillion-dollar question that policymakers grapple with every single day. Not if we should act, but how we should act to build a more stable economy for everyone.